Okay, let's just dive right into this explainer and demystify what is probably the most misunderstood topic in trading right now. Welcome, everyone. If you've been exploring smart money concepts, inner circle trader methodologies, or order flow, you've definitely encountered a confusing alphabet soup of acronyms. Today, we're focusing on two of the most critical yet frequently confused concepts out there: liquidity and change of character, or CHoCH. We're going to break these down visually, step by step, so we can finally start seeing the market exactly the way institutions do.
So why do so many traders enter a trade immediately after seeing a CHoCH only to get brutally stopped out like a few minutes later? Look, we've all been there. It is a really painful shared reality. You watch the chart, you see a sharp move, you think you've brilliantly caught the exact bottom or top of the market, you enter your trade feeling great, and then bam, the market reverses right back against you, hitting your stop loss. This happens because traders constantly confuse liquidity, CHoCH, and break of structure. They see a signal, sure, but they completely miss the context.
Here is our roadmap for today. We'll quickly cover the infamous CHoCH trap, move into market liquidity, explain change of character, compare liquidity versus CHoCH, explore the volume profile edge, and then finally, we'll put it all together.
All right, starting off with Section 1, the infamous CHoCH trap. This is all about learning to avoid that early entry.
Which leads us perfectly into Section 2, understanding market liquidity. This is essentially the market's fuel.
So, liquidity. It represents the areas in financial markets where a ton of stop-loss and pending orders are just sitting there, concentrated. Think of it literally like rocket fuel. Fun fact here, major banks can move billions in a single trade block. They can't just open an app and hit buy like we do, right? If they did, it would cause massive price slippage. They need huge pools of opposing orders, which is liquidity, to absorb their positions. They need this fuel to power their engine. When you just react to a line crossing on a chart without understanding this underlying mechanic, you often become the liquidity for someone else's profitable trade. To figure out where this fuel is hiding, we have to contrast buy-side liquidity and sell-side liquidity. Buy-side liquidity is typically found right above old highs. This is where short sellers place their buy stop-loss orders to protect their positions, and where breakout traders place their buy stop entry orders. Sell-side liquidity? Exact opposite. It rests below old lows, containing the sell stops of long traders. Institutional players actively hunt and trigger these specific liquidity zones. They'll intentionally push the price above an old high just to trigger those buy stops, giving them the exact willing buyers they need to offload their large sell positions before initiating a true downward reversal.
Moving on to Section 3, change of character explained. Let's examine that crucial first shift.
Okay, a CHoCH, or change of character, occurs when market structure changes for the very first time. Let's say you're in a downtrend, price is making lower highs and lower lows. A CHoCH happens the exact moment price breaks above the last lower high. It is the very first structural clue that the trend's momentum might be shifting. However, and listen, this is exactly where the trap lies, a CHoCH is just a clue. It is absolutely not an automatic guarantee of a trend reversal.
Just to visualize it, a bullish CHoCH happens after a downtrend, when price suddenly breaks upward past the most recent structural high. A bearish CHoCH happens after an uptrend, when the price dumps downward through the most recent structural low. It simply shows a sudden shift in short-term aggression.
Now, before we go any further, we have to contrast CHoCH with BOSS, or break of structure. This addresses a massive beginner mistake. A CHoCH is the first time the structure changes, hinting at a potential reversal. A BOSS is when that new trend continues and breaks structure again in the same direction. Think of it like this. The CHoCH is the initial spark. The BOSS is the confirmation that the fire is actually burning. Do not confuse a fresh character change with a continuing break of structure, or you're going to misread the entire market phase.
All right, Section 4, liquidity versus CHoCH. It's all about the order of operations here. When we compare these side by side, the whole puzzle really comes together. On the left side, we have liquidity. This is an area where orders accumulate. It is targeted first by the market. It's unintentionally created by retail traders placing their stops and actively used by institutions to fill massive orders. On the right side, CHoCH. This is a market structure signal. It occurs after a structural change has already happened. It reveals a possible momentum change, and traders use it for confirmation. The absolute golden rule here is order of operations. Institutions manipulate the liquidity first. The true CHoCH only comes afterward. If you're trading a CHoCH before liquidity has been swept, you're likely falling right into the trap.
Let's jump into Section 5, the volume profile edge. How do we confirm all this activity?
So, standard volume at the bottom of your chart shows volume by time, but volume profile, it shows volume by price level, mapping out exactly where the big money is doing business. Volume profile has three main components. First, the point of control, or POC. This is the single price level where the highest volume was traded. It's a massive magnet for price. Second, high volume nodes, or HVN. These are broader zones of heavy trading where market participants found a fair value. And third, low volume nodes, LVN. Areas where price moved quickly with very little volume, which often represents areas of imbalance.
And this right here is why combining these concepts is a total game changer. Liquidity sweeps near the point of control provide much stronger trade confirmations. Think about it. If price sweeps below an old low, grabbing that sell-side liquidity, and that sweep happens right at a heavily traded point of control, you have a massive confluence. It tells you institutions are highly active at that specific price, just gobbling up those stop losses. This acts as your ultimate safety check before you even look for a CHoCH.
Okay, bringing it home with Section 6, putting it all together. Let's walk through the chronological sequence.
All right, here is the exact playbook in action. Step 1. Liquidity must be swept first. The fuel has to be consumed, institutions trigger those stop losses, and volume increases. Step 2. Only after the sweep, we look for a CHoCH to appear, showing the structure is shifting. Step 3. We don't enter immediately. We wait for a retrace into a fair value gap that forms after the CHoCH. And Step 4. We execute our entry at the institutional order block, anticipating the trend continuation. Actually, let's keep it simple. If you try to jump in at Step 2 before Step 1 has happened, you're just flipping a coin and risking taking a loss.
So, just to keep ourselves safe, let's quickly review the specific traps to avoid. First, confusing a break of structure with a change of character. Remember, CHoCH is the initial shift, BOS is continuation. Second, entering the literal second you see a CHoCH without waiting for a retrace. Third, completely ignoring liquidity zones, higher time frame trends, or volume profile context. And finally, honestly the biggest killer of all traders, reacting emotionally and just chasing price.
Let's summarize our core philosophy today with these key takeaways. Liquidity is the fuel for the market. A CHoCH is your initial structural clue that the gears are shifting. A BOS confirms the new trend is rolling. Volume profile provides the institutional context to prove big money is actually involved. And most importantly, always wait for confirmation. The fuel must be consumed before the engine can truly drive the market structure in a new direction.
I want to leave you all with this really powerful thought. Successful traders do not simply react to price movements. They understand why price moves. When you master liquidity, CHoCH, and volume profile, you stop being a victim of the trap and you start aligning yourself with the institutions that are setting it. So, my final question to you is, how are you going to use these tools on your charts tomorrow to finally start thinking like an institution? Thanks so much for joining me on this explainer, and happy charting.